Rolling into thing number four, Gary, coming back to the Japan carry trade, we saw that start to unwind. You're saying there's more to go, which we know. Thing number four, Gary, brings us to the Japan carry trade.
So this was the source of Monday's market volatility. This is what happened when Andrews when his access to his Schwab account went down. Basically, what happened was we've talked about this at length. Japan has kept their version of the Fed funds rate. They kept it below zero for something like 9 years and around zero for much longer. And just recently, they decided to go above zero, and it was kind of funny because they picked their reference rate between 0 and a tenth of a percent. So basically 0.05%. This is like less than what people were getting in their checking accounts a couple of years ago. But we've talked about this before because of the carry trade, because the yield on the yen was so low, people were shorting it and buying US Treasury securities. And because there was so much selling pressure and the yield on the yen was so low, that the yen had plummeted. And they had gone from a couple years ago, something like 102 yen to the dollar, all the way down to 162 yen to the dollar. And so, that's a huge problem in a small island nation like Japan, which doesn't have a lot of natural resources and has to import energy. Energy gets priced in dollars, and when your currency slides 60% against the dollar, like, again, think about it. If anybody gets frustrated when you go fill your car up, now imagine another 60% against you. And that's what the Japanese were facing. So, in response, the Bank of Japan raised their rates to 0.25%. And that meant it was roughly a 35 basis point, 0.35% increase over the last 4 months. And what that did was started to make the carry trade less attractive. Now, people have said the carry trade is about $20 trillion, but nobody's really sure. I don't know the exact size of it. But as the Bank of Japan increases their interest rates, it causes people to start to unwind the carry trade. So, what that unwind looks like is people will sell US treasuries. For that, they receive dollars. They then sell those dollars. They buy yen, and they use those yen to buy Japanese bonds. And so that's the reverse of the carry trade. And with all that money flowing in the other direction, the yen strengthened from, again, like 162 to the dollar. I think it went to 146. I looked earlier today, it was at 147 to the dollar. That's still pretty bad, but it's a huge improvement from the point of view of the Japanese. But that was the event that caused Monday's market meltdown and all of that volatility. It was the Bank of Japan moving rates, by not a huge amount. They just moved rates 20 basis points, 0.2%, and it caused all of this. Well, what happens if they keep going?
Gary, there's a takeaway that you mentioned in that Japan will probably keep its finger on the button, threatening to hike again. But then we've seen comments from the BOJ that current rate levels may be unstable. Seems like kind of some deliberate uncertainty. What do you make of that in terms of their pulse on the market and that uncertainty and what it means for others?
So, Rob, that's a great question. And it's something that I've been puzzling over. Originally, what it looked like the Bank of Japan was going to do is deliberately insert uncertainty in the system. And that to me made sense. And I'll explain what I mean. So again, it's the carry trade that has put so much pressure on the yen. And the carry trade where people are short the yen, long the dollar, short Japanese government bonds, long US treasuries, that works. You have a guaranteed spread return as long as the currency doesn't move against you. And so if the Bank of Japan stays where they are and the yen stays weak, then you can make a huge amount of money in the carry trade without taking a lot of risk. But the risk that you're taking is that at any moment, the Bank of Japan could raise rates. And what that does is it strengthens the yen. And it means that you're short the thing that's going up, and you're short the thing that's going up quickly. And so my thought on this was, if you're the Bank of Japan, by deliberately inserting uncertainty into the system, you're warning the people engaging in the carry trade. You're warning the people who are short your currency, you could get hurt and you're not going to get advance notice. And we'll let you know, but by the time you hear the news, it's already incorporated. You won't be able to cover that short at anything close to the current rate. And I thought it was a really clever way to warn the people who were shorting the yen, this is dangerous and we may hurt you without notice. Now, that made sense to me. And instead, what's actually happened here is the Bank of Japan went the other way. And there were comments from people both inside and outside the Bank of Japan. And the outsiders were people who were connected or formerly part of it. And they basically said, we don't think we're going to raise rates again this year. If we do, we'll give you a warning. I've always talked about how quirky it is that our board of governors, our Federal Reserve governors are constantly in front of microphones, right? I think last week I joked that if I wanted to have a meeting of, all the governors of the Federal Reserve, all I'd have to do is put a lectern and a microphone in front of my driveway because these guys can't resist an open microphone. The Bank of Japan has been more careful about that, but for some reason they've actually come out and tried to calm that market and tell people it's okay. We're not going to raise again this year. We'll give you warning before we do. Between the two of us, I don't really know why they were doing that. I thought from their point of view, the uncertainty was serving them better. But we'll see what happens. I think either way, they're stuck. If you keep rates where they are, the yen will continue to slide and they're going to experience inflation. If they raise rates, they can't afford it. Their debt to GDP is 260%. They'll blow out the budget, raise their interest expense. The only way they can pay for that is to print more yen, and the result of that is going to be more inflation. In my opinion, the best move for them would be to raise rates, but either way, they have a big problem.
Yeah, I think we had some bets on that 260% that are looking pretty good, if I remember correctly, a few months ago with the five things. But
Yeah.
we'll keep the pulse on the BOJ and the moves that they're making and how it's going to be affecting the markets here. Gary.